Hello, ladies and gentlemen. This is Professor Sides, and this course is Principles or Rules of Macroeconomics. When we speak to macroeconomics, as opposed to microeconomics, we are speaking to the study of the behavior of large-scale economies, whereas microeconomics is the study of the behavior of individual households, organizations, or industries. Organizations will be represented by firms or business, and then an industry. Our study will look at different parts or facets of a whole economy. In this chapter, we will focus primarily on an economy's income and expenses. This is necessary to determine that country's growth opportunities or growth potentials, which we will look at later in this chapter. For the balance of this semester, our default macroeconomy will be the United States, but from time to time I may reference other nations to give better understanding or clarity. There are many indicators which measure a nation or a macroeconomy's health. The first indicator which measures that health is called GDP, or Gross Domestic Product. It measures both the income of a nation and the expenses of a nation. There are other indicators we will discuss throughout the semester, but for right now, this series of lectures will focus on GDP. The easiest and best way to measure an income is to follow the money. In economics, we do this through the circular flow diagram. It shows graphically how money flows within an economy. In a circular flow diagram, you have two participants. You have the household, which are the consumers, that's you and me, and then you have the firms or the businesses. In microeconomics, we use this model to describe the market. Again, when we talk about households own factors of production and they buy and consume goods and services. And the firms or businesses will hire or buy the factors of production and use that to produce output or to sell goods and services. This model shows us the reality of the flow of money. As you can see here, households provide factors of production, and the factors of production are land, labor, capital, and technical knowledge. We'll go into details about that later. They provide that to the firms, and then the firm in turn take those factors of production and produce output or goods and services and sell them back to the household. Now, what makes this circular model complete is that the firm when they sell their goods and services, they receive revenue, which is counted in GDP, and then they take part of that revenue and use that for wages. Rent would be the mortgage on the facility or the rental of space, retail space, and profit. And so they take a portion of that revenue to pay out wages, rent, and if they are a publicly traded company, parts of the profit in the form of dividends, which becomes income for the household, and then the household use that income to spend on goods and services. This diagram in its current state is incomplete. There are three components which are missing. The first is the government sector. Again, if you recall back to the diagram, we only showed the household and the firm. The government plays a part through the form of policies, and we will talk about this in later chapters. The second component that is omitted from this original diagram is the monetary system or the financial system. That's the banks, where loans are made for investments and savings. And we'll talk about that in another chapter later on in the semester. And then the final, third and final component is the foreign sector. That lends itself more towards international trade, and that is beyond the scope of this course. It's generally reserved for more advanced economic classes. Now that you know more about the circular flow diagram, you are now ready to move on to the next segment of the lectures, which includes a more detailed definition of gross domestic product. I'll talk to you soon.